Hi, this is Ty, and I'm coming to you from my garden here in Portland, Oregon. I'm doing a few videos on the topic of how our consulting firm, TCA, sets up a planning model for companies. And in a prior video, if you haven't seen it, I talk about what I mean by a planning model, and also I kind of go briefly through the 5 steps that we would walk through to set up a planning model and then work the planning process with a company over time. And so this video, it'll be kind of a short and sweet video about the first step in the process, which is really talking about what we say scrub your accounting. And what I mean by scrubbing your accounting, there's 2 pieces to it. One of probably the obvious pieces of it is, well, I shouldn't say obvious, less obvious I think actually, is taking the opportunity to evaluate your chart of accounts. So what happens when you are operating a company and you've been doing the books for a while for that company, it's very common that your chart of accounts becomes bloated. You've got a lot of accounts in there that really there's no reason to them anymore. And a lot of times that happens because they were single-use accounts. There was one year or one period of time where either you, the CEOs, the owners, the leadership team, or maybe your tax accountant said, hey, you know what, it'd be nice or cool if you could separate out this particular expense or this particular item into its own account, and you did it for a little while, and then the reasoning for doing it just went away. And that's a very common situation, that your chart of accounts becomes bloated, or somebody thinking ahead of time when they set up your chart of accounts just thought in the abstract about all the different things that you might want to track, and so they set it up with lots and lots of accounts to begin with, and then after you actually got running the business, it turned out that you actually didn't have to track all those different things, or you didn't track as many things as separately as you want. So this is all one big long explanation of the point that it's very common for an operating business, a business that's been operating for a while, to have an overblown or bloated chart of accounts. And so what we want to do when we're setting up a planning model, we set up our planning models in Excel, and part of that planning model is an income statement. And that income statement, we want to match exactly whatever is in the accounting system. So we want the line items in our Excel model to be the exact same line items that are in your accounting system. So for example, if you're using QuickBooks and you've got all these different accounts on your income statement, lots of different kinds of expenses on your income statement, however many expense line items you have on your income statement, we want to have exactly the same number of line items with the exact same labels in our planning model. And once you start thinking about it that way and you realize, well, yeah, I don't think maybe I need it in my planning model because I'm not actually going to plan, I don't know, let's make up something like office expense and office supplies. It's not really the case that I'm going to sit here and talk about or think about how I'm going to plan what I spend on office supplies differently from what I spend on office expense, right? Now maybe you do, and that's okay if you do. So I'm not saying you shouldn't do that if you feel like you need to, but for a lot of businesses, they're not going to do that. It's going to be basically the same drivers, the same estimate of maybe some percentage of sales that they'll allocate as I can spend this much, or I usually spend about this much on office stuff. And so there's really no distinction in the planning cycle between office expense and office supplies, at least not in the example I'm putting forward here. If that's the case, then I would ask you, if there's no distinction in how you're planning for that item, then why would there be a distinction in how you account for that item on the back end? There really shouldn't be, is my point. And so you probably ended up with 2 line items because it made sense at some point when this was being set up, but in reality there's very little distinction between the 2 things, and so maybe you should simplify your accounting process. Anytime you can simplify your accounting process by simplifying your chart of accounts, it's a good thing, not a bad thing. There's no reason to be overly complicated with your chart of accounts. Simplify it. And the threshold test, the litmus test, the question as to how simple can I be or how complicated should I be with my accounting process and my chart of accounts, from my perspective, you answer that question with thinking about how you would plan. So if it makes sense to you that different line items, different expenses have different drivers, like how I budget office expense would probably be different than how I budget meals expense. How I budget my technology expenses will probably be different than how I budget for my salaries and wages, right? So they're distinctly different things. What drives those things are different. I'm going to budget and forecast and plan for them differently. So because I'm planning for them differently, then I would want to have separate line items on my planning model, which means I would want to have separate accounts in my chart of accounts. You see that? It goes both ways. The logic of why we would have something separate in the planning model is the same reason why we would separate in the chart of accounts, or vice versa. If we have a really good reason for why it should be separated in the chart of accounts, that reason should carry over and make sense when we're putting together the planning model. So that's part one of scrubbing your accounting. Part one is revisiting your chart of accounts and really getting it set so that you've consolidated things, you've combined accounts that don't need to be separate, you've minimized the accounting process so that you've got a very easy accounting process, and that those lines in the future can be easily compared to what you have in your planning model because you want them to be exactly the same lines. Okay, well, the second part of your the second part of scrubbing your accounting is just quite simply what I would say, cleaning up the books. Okay, so cleaning up the books, what I mean by that, and I think perhaps this part is more obvious to many of you, is you got to make sure all the historical transactions are accounted for. So the first part of that is making sure all the accounts are reconciled. So all the bank accounts, all the credit card accounts, all the loan accounts, every kind of account has to be reconciled and proved out to your documentation and all that. That's just good normal bookkeeping, and that needs to be done, and it should be done usually on a monthly basis. But my point here is, we can't really start the planning process if we don't have faith in the prior accounting, right? So we're going to use the prior accounting in order to establish an understanding of relationships and trends. And so before we jump into a planning model, we want to make sure we've got good data to work with. So we've got to make sure all those historical transactions and all the accounts are properly reconciled. And the other way to think about that is we need reports. So we need financial statements, balance sheets, and income statements for the prior 12 months at least. Ideally, if you've been operating for many years, it'd be great to have balance sheets and income statements annually for at least the last 3 years, perhaps the last 3 to 5 years. But at a minimum, for the process that we work through, we want to have a monthly financial statement, monthly income statements and balance sheets for the last 12 months. And if we can't get that because the accounts haven't actually been reconciled, and the books aren't up to date, and the reports just aren't available for those last 12 months, then we're dead in the water in terms of actually putting a real good planning model together, because we don't have the historical data to actually look at trends and relationships from. All right, well, the next step in our planning process is going to be to take our clean set of books, our pared down chart of accounts that's no longer bloated, set up our model, put 12 months worth of transactions into the model, and then the next step is for us to identify those key performance indicators. So that's what I'm going to talk about in the next video on this topic. That's it for now. Hey, if you're enjoying these videos, please hit the subscribe button. Tell your friends and colleagues about it. We want to build this community as much as we can. Thank you, and I'll see you in the next video.